live yet, but just one more minute we will be. And here we are, yes. Okay, now I am so excited to be actually starting on time compared to last time when I got all messed up and didn't start on time. So this is a good thing. We are officially live with you today. Sheila Roberts here, USA Today and Publishers Weekly best-selling author, with my amazing, brilliant husband, Professor Gerhardt Roberts, who I have to brag a little. Some of you have already heard me brag, but he has just earned his doctoral degree. And we're very excited. We're going to be celebrating his graduation here end of May. So very exciting. But he also, before he became a professor, my husband happened to work in a bank, and he has done a lot of things over the years with finance. In fact, he manages ours. You know, there are two different types of people. There are the people who like are detail oriented and they run things. And then there are what we call the free spirit. And I bet you can guess which one is which. So I am I can understand concepts of money, but Gerhardt is the one that does the managing. He manages for our business and our personal accounts. And he, as like I said, he was a banker before he became a professor. So he knows stuff. So we're going to talk about some very important money things here. I see a lot of you coming in. Hi, everybody. Thank you so much for joining us. I really hope this is going to be very helpful to all of you. Oh, I see my friend Carol has joined us on Insta. Glad to have you all with us. There are all kinds of ways. There are all kinds of little sneaky money pickpockets out there that take money out of our wallets when we don't even realize it's happening. But we're going to talk about the big three, and it all has to do with interest. Settles around interest and how in these three areas we really can pay a lot of interest. And we're going to get to that in just a minute. But first of all, a word from our sponsors, us. I'm going to show, first of all, some of you I know when Gerhardt first wrote this book. I want to tell them just quickly, where is this set and what's the time period?
1930s, 40s in Germany during the Nazi era.
Yes, and people hiding, and if U-boats. You may think that's a boat, but it's not, and you'll have to get the book to find out. Where can they get this?
Oh, Amazon.
All right, Amazon. So support your local writers. So, and the one, of course, mine, up and coming, Love on the Shelf. I hope you all have pre-ordered it. Please do, because it will make my publisher very happy and it will keep me employed. So I would love it if you would pre-order this. It comes out end of May. It's a very fun battle of the sexes and involving a radio shock jock and the owner of a romance bookstore. So it's very fun. And those are our products that are sponsoring today's episode with all of you. And we are going to be talking about interest and where it cuts into us in the three major things we all spend money on. And that is our cars, our credit cards, and our homes. And we're going to just talk about this in some general terms. And Gerhardt actually has some financial examples to give you so you can see what happens and how this all works. Oh, Linda, thank you for saying that you pre-ordered my book. That just makes me so happy. By the way, a big shout out. One of my Sheila girls is on here. I see a couple of them. And we've got several states already that have joined in. Wisconsin is here with us, and Illinois. Who else is here before we get started? Zephyr Hills, Florida. Hi, Debbie. Oh, yeah, many of us here. Thank you so much for joining us today. And I think this is going to be very useful information. There is so much to dive into, but we will try and make it as easily and understandable as possible. Some of you might be like me, and math is not your forte, but Gerhardt's going to try and make it easy for you here. So let's start with cars. Because we almost all of us have one, drive one, are always replacing one, getting a new one. And boy, this is a place where we can really end up paying a lot more for that car than we think we're paying. So we're going to just take some examples here. And of course, I know that cars range in prices. We're going to be relatively modest in our price. And I'm thinking around 30,000, right? Is that what you calculated on, or did you go higher?
Oh, I went 30.
Okay, you went 30. Okay, that's the reason we picked that. You can get like, probably you're getting an SUV, you're gonna pay more like 50. We went for 30 because that's about what we paid for our Toyota Corolla hybrid, which, by the way, you guys, I'm still trying to get along with. That car seems to be a magnet for me to run into things. You can save a lot of money if you don't run into things, but that's another story. Anyway, so we're gonna take that as an example. So let's say we have gone to the car dealership. First of all, when you go in, you have a theory about what you say when they say, how do you want to finance this, right?
Well, before you do that, you do some homework because the dealer will offer you a certain rate. And you might get a better rate at your credit union or at your bank, even at your insurance company. Some insurance companies are banks also. So be sure that if you're planning to finance, that you know the best rate, because the car dealer might not give you the best rate. But when you go in there, they'll ask you, well, how are you going to finance this, or how are you going to pay for this? And usually what I say is, I'll consider the options as we go through the process. I'm not going to say right up front, we're going to finance, and they will check your credit score. And if your credit score is lower, they're going to actually kick up the rate because you're a higher risk. And if your credit score is high, you get a lower rate. And that happens with banks too. So you have to do if you're not going to pay cash, you'll have to do your homework to see, the best rate you're going to get.
And the best thing is, of course, to pay cash, but I know we can't always do that. We certainly advise save up. Drive your beater till you can afford to save up for a new one. Oh my gosh, remember some of our early cars? They were beater. I remember the kids at the high school drove newer cars than we drove, but they were free and clear. So anyway, let's get down to then, okay, to the whole interesting. Now we're ready to wheel and deal on this car, and the average, it appeared to me in doing some research that the average car loan these days goes for 5 years. So and I was looking at the average interest rates. I saw was it between 6.27 and 16%, right? So we're going to go conservative. What interest rate are we going to figure?
We're going to look at 6. Let's say your car costs $30,000, which is a pretty low figure for a car these days. But if you finance at 6% for 3 years, you're going to pay about $38,000 for the cars. So, and if you go to 4 years, it's going to be over $40,000. 5 years, 42, 43, like that. And then I guess what you have to do is say, well, do I want to pay that much interest? What could I do? Let's say with a 5-year loan, if I'm paying another 6, 7, 8,000 in interest. What could I do with that money if I just saved it up, and I didn't have to finance it? So get your ducks in a row.
Okay, so theoretically, my $30,000 car, after 5 years of paying for it, has cost me
close to 40,000, maybe a little bit more if it's 6%.
Guys, that's another $10,000 you just spent on a car. Just on interest rate. My goodness. So that's a little shot. I can do a lot of stuff with 10. My gosh, we could take a European cruise for that.
Yeah.
So, these are things to consider, and we don't realize it because the average person, most of us, again, have not put that many pennies in our piggy bank. And so, of course, oh my gosh, we got to take out a loan. And once you've got to do that, then you're vulnerable. You put yourself in a position where you've got to pay all this extra money that you normally wouldn't have to pay. So as we're doing comments, by the way, I will say, I'm going to pick a name here later on today, or actually I'll make Gerhardt do the eeny, meeny, miny, mo, and somebody will get a copy of my book, How to Live Large on a Small Budget. So I appreciate y'all being here, commenting, being with us live today as we're talking about these hidden expenses called interest rates. By the way, I'm looking, guys, sorry it's a little dark in here. The sun has gone down or disappeared behind the clouds, and we're a little in the shadows, so I apologize for that one. Gerhardt's talking, I might sneak away and see if I can find another light to put on somewhere, but you don't need to see us as much as you need to hear us. So I hope that message is coming through loud and clear. But in the comments, I would love to know, how many of you have just paid cash for a car? And how many of you have ever bought a new car? How many of you are stuck paying car payments? The average car payment is, I looked that up somewhere, the average car payment runs about $800 a month. Now, if you're on a tight budget, that is a lot of money coming out of your budget. And that's money that you could be using to invest in your future and set money aside or be putting in an emergency fund. That's another story though, so we won't go to that, right? All right, so cars. So what's our workaround then if you don't want to end up paying all this money in interest? Do you have some thoughts on that, Gerhardt?
Well, save up the money.
There you go.
So also you can get a used car. Now the interest rate will be higher on a used car. You'll find the banks feel that a used car is more of a risk because it isn't new. It won't last as long, so you'll have to pay a higher interest rate there if you do finance it. You can buy privately. In that case, you're going to pay less than on a car lot, and you would then have a chance. And I would recommend this if you buy a used car to drive it around for a little bit and maybe even drive it past or to your mechanic, and have your mechanic check it out for you. He can or she can check the compression of the engine, quickly look at the brake situation, et cetera, et cetera. And if you have your plan lined up and go on a test drive, you can have him or her quickly look at it for you.
I love that. And yes, Sherry says we always try to pay cash for a used car in our budget. I love that. She says, I think we only had one loan and it was on our worst car. Oh my gosh. And we have never bought, this is only our second in our lifetime, our second new car that we've ever had. Our first new car, we drove that. How long did we drive that other Toyota? 15 years, 10 years?
Yeah.
A long time. We drove that thing almost into the ground. It's actually still going. Another family member is using it now. But, they always say, well, don't buy new because it'll lose value the minute it goes off the lot. Well, if you're buying new and you're like us and you're going to drive that thing till it drops, that's a different animal. But that is something to consider. Cars are something that do not go up in value. They go down in value. So if you can buy something used to tide you over, you can always work your way up to something better, but start with what you can afford, save up some cash and pay cash for your car. Another thing I was looking online, and I have not done this, but I see that if you go with some of these online platforms like Carvana, you can maybe get a deal. And with that, it would appear that you actually have a grace period, try the car out, whatever. And if that's not working, you can return it and try again. So that's something to keep in mind. Hi to those of you who have just come. Thank you. Pam says that lighting is better. Yes, I was going, why is the lighting so bad? I have found some other sources to turn on so you can see our smiling faces. Anyway, so I hope that helps a little and gives you an idea of what those sneaky fees that you are paying that you don't realize, because sometimes well, I just need to know what my monthly car payment is. Well, as you can see, even that is high. But the other thing is there is this little sneaky pickpocket going in your pocket, pulling out money because of interest that really you don't want to pay that much extra for your car. Let's move on to big thing number 2. And oh my gosh, this hits a lot of us. Good old credit cards. You guys, I bet a lot of you know this, but for those of you who don't, credit cards have not always been with us. The first credit card came out in 1950. And that was the diner's card. And I don't know who had that bright idea. It was like, oh, you can dine out on these different restaurants and use this wonderful card. It's kind of like eat now, pay later, right?
Diners Club card.
Oh, Diners Club. Yes, Diners Club card. And then a little bit later in the happy 50s, about 1958, Bank of America said, this is not a bad idea. Let's loan people some money to get what they want now, and we'll just charge them some interest for the privilege of flashing that plastic. And so after that, of course, the race was on, and now credit cards are ubiquitous. Let's see, what does Luann say? I have a 1999 RAV4. Oh, those are a good car. That is only 65,890 miles. Bought it new with 7 miles. All right, you're going to get your money out of that. That's great. Yeah, I certainly have no problem. I mean, I love it if you can get a new car. But of course, the thing is, we want to try to be able to finance it ourselves without depending on the car dealership or the bank or whoever to help us finance it, because they're going to take their chunk of money from you. So we want to be generous, but I don't want to necessarily be generous with the bank. I could find other causes to give my money to other than them. Yeah, Kathy said credit cards are bad juju. Well, they kind of are, and we're going to talk about that because we kind of took a fictional couple here, and we're going to give you an example of what happens with them with, what did we call them? Oh yeah, Annie and Adam average. And there's such a thing as interest and compound interest, and Gerhardt, the finance expert, is going to take it from here and explain, because we were trying to talk about this earlier. I'm going, all right, I still don't get this, except I know it's adding up. So let's see if we can put this in language that even those of us who are creatives will understand.
Okay, well, most credit cards, if you look at the fine print, would charge about 20% on your money. And that adds up in a hurry. We have this couple here who's a scenario who charged $500 in a month. Now,
of different things, food,
for different items, but the credit card company will typically just be quite happy with your minimum payment, $35, $40. And if you charge $500 and you pay the minimum $40 payment on that through the life of the balance, it'll take you over 5 years to pay off that $500 because of the 20% interest.
Oh.
It's just a phenomenal rate. And so I calculated it. I actually went online and found a calculator. And if you pay the minimum payment of $40 on $500, you will end up paying $2,400. So you'll pay $1,900 in interest. 20% is a great, if you could get that on your money, that's great, and the banks do. So if you want to like buy a TV for $500 and pay it off over 5 years, that's great. The thing is, you paid $2,400 for a TV that's probably not worth more than $500. So the thing is, have the money in the bank, for what you need, and don't use your credit card for emergencies. You should have an emergency fund, 3 to 6 months of your income. So if you make $5,000 a month, you should have $15,000 for if you need new tires, or if you need whatever that's a high ticket item, so you don't have to charge something and pay 20% interest a year.
That used to be called usury, I thought, if it went over a certain point.
Yeah, today usury, I don't know, I think it's approaching 30%. I'm not sure, but that's pretty close.
It's horrifying. And we've got some comments here. I'll just try and share. I'm trying to keep up with the comments, but Nicole had said, she says, businesses always want me to sign up for their card. Well, why do you think, guys? It's not to benefit you, because that's one more place where interest is going to rack up. And I have to tell you a tale. This was years and years ago, before we had Macy's. It was called the Beau Marché. And I remember getting a card because someone said every woman needs credit in her own name. And I know that's, I won't go down that road because that's a whole nother bunny trail. But I thought, yeah, I need to do that. So I got my little credit card for the store. And oh my gosh, every month they had this fabulous sale. And every month I'd go in and buy all these cool clothes. I was having a wonderful time with my card, but somehow I got behind and I was doing the minimum payments and I wasn't keeping up. And all of a sudden this thing had snowballed out of control. And I went, wait a minute, this is not helping my anything. This is a bad situation. And it just kind of sneaked up on me. And I think that is often what happens with credit cards, because it is so easy, right, to just put that plastic out. And with us, we have, and I know who said that, was it Pam? Yeah, pays off her credit card every month. And we do that. I have a budget that I have to stick to. And once I've hit that line, the fun is done. The charge card gets put away and I don't use it. And of course, there are some benefits to credit cards. If your credit card gets stolen, it's a lot easier to make sure that doesn't snowball out of control than if you have a debit card, because debit card takes a while to get that sorted out, right?
Yeah, well, with a debit card, your money comes out immediately. It's harder to recover it.
Yeah.
But if you lose your debit card, but normally a debit card will have a PIN number. But with a credit card, the credit card companies know that a certain amount of people are going to make the minimum payment, and they're going to make literally millions of dollars. That's why they can then give you, your 1 or 2% reward on your credit card. It's no sweat off their nose because they're making millions on credit cards. The sad thing about debt is that you have to prove yourself to get a good credit cards, to get a good credit rating with the top three companies, Experian and Equifax and TransUnion. You have to actually go into debt and make sure you don't pay interest. That's my recommendation, to get a high credit score. And so sadly, that's kind of the way the system works. But the thing you don't want to do, obviously, is it's easy to pay the amount, but it'll turn around and bite you because of the scenario that I explained.
So these things, the compound interest, it compounds.
It compounds daily. And so if 20%, what they do is they take 20%, they divide 365 into it, and they get a daily rate, which they apply. And over a month, that really, really adds up into a lot of money. And so it seems like a really small number, but they'll apply that to the outstanding balance. And after a year, it will be quite a large amount of money. You'd be surprised.
Well, small numbers have a way of adding up. That works both ways. I mean, think of the different ways, and I know we're staying with the major three interest issues, but just talk for a second about little money drainers. We all do them. Maybe we go out to lunch one too many times with the girls. We love to buy that blended drink. Those, I mean, my goodness, those are, I don't know, $4 or $5 a pop now for that. And that adds up. If you have one of those 3 times a week, okay, that's $15. And then 15 times 4 is 60. Is that 60? My math. But there's $60 that just dribble it away down your gullet and then enjoy yourself on your hips. And not that I'm going to tell anybody not to have their blended drinks. I love mine, but it adds up. Conversely, if you're saving a little at a time, that adds up. And I know Gerhardt talked about how much you should have so much money in savings for emergencies, and all the financial experts will tell you that. But that large number can sound terrifying and intimidating. I mean, many of us say, how am I ever going to get that amount of money in an emergency fund? We're going to do it little by little. And having something, even if you have 500 in your emergency fund, that's a good beginning, and that's better than nothing. So if things have a way, things go away little by little, and things add up little by little. And I think that's an important thing to keep in mind, especially when we're talking about interest. Let's see, Pam says, only $4 for drink, cheap where you are. I can't remember. I have my little, my little Starbucks thing that I pay. But of course, then when that's done till the next time.
So you should also have a budget so you know where every dollar goes, and try to stay out of debt. There are a lot of websites where you can go online and have an explanation given to you of how to set up your budget so you know where every dollar goes. If you are in debt, like DaveRamsey.com, you go there and for free they'll show you how to set up a budget. But if you are in debt to a lot, and Sheila listens to Dave Ramsey all the time. People call
I am a Ramsey fan.
They're over $50,000 in debt on their credit card. And one lady called in today. I think she had like 8 or 9 credit cards that she owed money on. And if you are in debt in that way, the recommendation is to attack the smallest debt first. Just chomp away at it, get rid of that, go to the next one, go to the next one. If you are like to go out for dinner, don't go out to dinner.
Yeah.
And just don't spend the money that you could be applying to the credit card to get rid of it, to get rid of the that debt. Some people even recommend putting your credit card in a glass of water and putting it in the freezer. That way, it might be harder for you to use. I don't
Quick,
know.
where's the microwave?
But anyway,
Yeah, and by the way, I do want to give credit to Dave Ramsey for that, because that's part of what they call their debt snowball. You attack one at a time, get that done. And I think that one lady we listened to is such an example, because things get away from you little by little. It's like, oh my gosh, this card's maxed out. And instead of saying, oh, well, now I need to turn off the spending machine. Okay, well, now we'll use this card. And that's how we get into trouble. It's, we don't instantly get buried in an avalanche of interest. It creeps up on us inch by inch by inch. So I think that's a really good thing to keep in mind. Yes, and Nicole goes, give every dollar a purpose, right, Gerhardt? And Gerhardt would say, yes. Right. And I think that's really important. And by the way, our car that we bought in July, we bought that before that they were worried the tariffs were going to come in, and the dealer had said, well, after such and such time, it'll probably be another $7,000 for the tariff. We went, we're going to avoid that, and we're going to pay cash, and we're going to avoid that. And so I'm not sure how many thousands of dollars we avoided by having saved up it. And it took us a while to save for the car, guys. I don't want you to think that we're bazillionaires here. We got nothing but money laying around. We don't. We save for everything very meticulously, and it took a while. But we saved, by doing that, we saved so much money because we didn't have to pay interest. And I know there are a lot of you out there who are good money managers and already know this, but maybe you just needed that pat on the head to say, yeah, you're doing a good job. Or maybe you're going to want to have somebody watch this and say, look, why don't you watch this and see how those little sneaky things add up? So those three things. Now we're going to get the other big three. The other big thing is our house payments. And of course, I know, most of us do not have thousands and thousands of dollars sitting around to go out and pay cash for a house. I get that. Most of us have to have a home loan. And so we're going to talk about how the interest works with your home loans. Oh, first, what did Cindy say? Prepaid credit cards and Starbucks gift cards. There you go. Yeah, when they say, what do you want for Christmas? I want a prepaid credit card. I want a Starbucks gift card. Anyway, but getting back to the house. All right, so let's just take an example using some averages. House values are so different across the country that we have to take a median price. So it would appear that right now, the median price for a house in the U.S. is $400,000. Now, some of you have gotten your house for less. Some of you have paid more. Some of you are still saving, hoping to get a house. But we're going to talk about just the average $400,000 for a house. And now banks prefer to offer a 30-year mortgage. And I bet you can figure out why. And Gerhardt's going to talk about that in a minute. We're going to calculate if we are using a current rate of 6%. Over 30 years, how much extra are we paying for our homes?
Well, your total payments it's about $2,000 a month. Your total payments for a $400,000 house will add up to $720,000 over 30 years. So again, ask yourself, well, maybe I can pay a little bit more, shorten the term, and what could I do with $320,000? That's more than $10,000 a year that I could use for another purpose.
That's just shocking. It's just shocking how much interest. And of course, because it's over a long period of time. And again, like with cars, we just think, what's the monthly payment? That's what we want to make sure. Can I make the monthly payment? And I will tell you that realtors, and my parents were in real estate, and we know a lot of really good realtors. But I remember when we bought our first home in the burbs, and the realtor, here was our budget, and he took us to look at a more expensive house. I remember what he said. I don't know if you do or not. Do you remember what he said?
No, go ahead.
He said, you're going to make more. Your income's going to go up. And so make the stretch. Get this really cool house that you want. Well, we did make the stretch, And we survived, but only because we wound up moving from that house and onto some family property and turning a little funky summer cabin into a house. It was a good thing we did that, because shortly thereafter, this was when Gerhardt was the bank, they were trimming middle management, and guess who got trimmed? And all of a sudden, guess who didn't have a job? It was a good thing we had sold that house and we did not have debt up to our eyeballs, because we'd have been in big trouble, right? And so sometimes you have to think beyond the what can I afford this month. It's like, what can I afford in the long run, and how am I going to be able to take care of this? So again, this adds up. So workarounds, I know there's a way that you can pay a little bit extra every month, or is it every month? Well, Gerhardt's going to tell you how. There's a way you can shave down some of that interest you're paying on your house. So share your tip.
Well, the method that you can pay a little bit more every month, of course. I would suggest that you make an extra payment every year. Now, if you have a 30-year mortgage, let's say it's $2,000 a month, and you make an extra payment every year, and that could actually boil down to making another $200 or so dollars a month. You can do it that way too on your payment. But if you do either $2,200 a month rather than $2,000, or one extra payment of $2,000 anytime during the year, the 30-year mortgage will go down to 18 years. And so what could you do? You'd have to ask yourself, with another 200, actually it works out to 2,000 times, how many months would that be? Let's say about, anyway, it works out to about, $150,000 or so that you would save. I'm just giving you rough figures, but it would be $2,000 extra dollars a month for those 12 years you would have paid. I can't do it in my head, but
you can't.
Well, I'd have to get my calculator out, but just imagine having, instead of a mortgage for 30 years, after 18 years, it's done, and you've got $22,000 a month for another 12 years. That would come in handy.
Yeah, and Kelly, I'm reading Kelly's comment. She said, we put an extra payment every year and paid it off so much faster. Yes, that is huge. And I know a lot of people sometimes advise if you can get a 15-year mortgage, that's even better if you can make that work, because again, it's less time that you're giving interest to the banks. The banks, they're the ones with the money, and they're saying, look, you can use our money, but we're not a charity. We're not giving this to you for free, and we're going to charge you interest. And so that's why it's a really good thing to make sure you've got a hefty amount for your down payment. Make sure that you're buying a house that really is in your budget. You can work up into a bigger and better house as you go along. And for many of us who are older, we've been there, done that, and now we're going the opposite way. We're downsizing, So sometimes, even with kids, you may not need as big a house or as expensive a house as you think you need. And you start small. Oh my gosh, you guys, our first house, people pay more for cars than we paid for our first house. And it was funky. I got to tell you, it was funky. That thing was built, when did we figure? The 30s?
1920s.
No, 1920s. It didn't have the basement was like dirt, and there was a sump pump and a swimming pool for frogs. It was on a nice property, but the thing was old. The heating system was, I bet you might have seen that on the Waltons or something. It was like it was an oil heater, right? It was a box that sat in the middle of the living room with a stovepipe thing. And it was, there were so many things with that house that I think today anybody on House Hunters would not even go within a mile of that house. But it was a starter home, and then we slowly worked our way up. And I think whether we're thinking cars or homes, it's a good idea to think we're going to start small and we're going to grow. So I just think it's really important to keep that in mind. How we get into trouble is the old joke about your eyes were bigger than your stomach, and that often happens with us. Let's see, what does Nancy say? I bought a cheaper house, made the mistake of getting a balloon payment, loan. Those were big back then. I remember those, Nancy. When it was near the payoff date, I still had a ton left, tried to refinance at that bank, and told her I wanted a 15-year loan that was not a balloon payment. Lo and behold, I went to sign the papers and she had made it as a balloon payment loan. I told her this was not what I asked for and left and went to another bank and got a 15-year loan like I wanted, paid my house off a few years later. Good for you. Oh my gosh. It just, yeah, balloon payments. You want it for those who, I mean, probably everybody here knows, but for those who don't, tell us what that is.
Well, they just, they kind of give you a break on the interest and on the payments and on the mortgage payment. And then partway through the loan, you've got this huge amount you have to come up with. So not a good idea.
No. Joanne says right now we're living in too much house. Want to downsize. Yeah, the timing has to be right, obviously, but I just think the biggest thing to remember, if you can come up with a little extra and pay that house off a little earlier, you're going to save a ton in interest. And the same thing, with the car, if you can not end up financing it, that would be a great thing. You'll save a fortune to save up for it. And again, the credit cards, be cognizant of what's going on. Don't not pay that off at the end of the month if you're going to be using your credit card, because it will sneak up on you. And all of a sudden you'll be going, how did I get here, right? So anyway, those are our thoughts for the day for you all, and I hope you have found that helpful. Hi, Karen has just joined us. For those of you who have just joined us, this will be hanging about on YouTube. It'll still be on Facebook for a while. Instagrammers, it won't be here for you, but you can, like I said, find this later on YouTube, along with so many of my other interviews with different offers and influencers, and even we have some wonderful finance things with my friend, financial planner Peggy Doviak. So lots of backlog of good interviews, and I appreciate my sweetie coming on and sharing some of his insights and the things that we've learned over the years. I hope you found that helpful, and feel free to post questions here even after we're done on Facebook, and we will try and answer them. But meanwhile, I appreciate you all taking time to come. I do believe I have something scheduled again for next Monday, and if I'm remembering correctly, it's somebody really cool. They're all really cool. So be sure to check things out and make sure that you hang out with us again, maybe next Monday as well. But thank you. I hope that helped, and good luck with all of you with your money. Remember, it dribbles away little by little, but you can save it up little by little too, guys. So don't give up. Don't give up the fight. Said bye to our Instagram people and now Facebook. All of you, thank you so much for joining us. I sure appreciate it. And please, guys, don't forget to pre-order a copy of Love on the Shelf. And don't forget, I'll show you one more time. I love this cover. Gerhardt, if you haven't ever read Gerhardt's book, he has another one out there too called The Wall Between Us, and that's a Cold War story. So do support your favorite starving writers. Not that we're starving, but support us anyway. Anyway, have a great week, everybody. We'll talk to you later.